Hi, my name's Bob White here, and today I'm going to present a case study in how you can use the Eumonics platform for hypothesis testing. And to be specific, this is going to be a case study involving equities and relative strength analyses. So let's start by discussing what is causal knowledge. Causal knowledge is what you think of intuitively when you see the words causal and knowledge. Causal knowledge is when you have an understanding of the relationship between a cause and its effect. So for example, if you press on a car's accelerator, the car will speed up. Conversely, if you press on the car's brake, the car will slow down. Having this kind of understanding, having causal knowledge about any real world situation can be extraordinarily valuable. In particular, if you have a causal understanding of stock price movement, that can make you billions or trillions of dollars. So everyone who's familiar with in stock investing is interested in causal knowledge. Well, where does this come from? Where does one acquire causal knowledge? Causal knowledge is developed with hypothesis testing, and this is also known as the scientific method. So the general idea behind hypothesis testing is that you propose a hypothesis, a conjecture of some kind. And that conjecture is a proposed explanation of a causal relationship based on some sample of data, usually a very small set of data. And when you go to test that hypothesis, what you do is you expand the available data that you're going to use, and you're going to look for two things. You're going to look to see if the hypothesis explains historical observations and if it predicts experimental outcome. Now, the hypothesis has to do both. For you to say that you found some causal knowledge, your hypothesis has to explain historical observation and predict experimental outcome. So here's our case study. Now, this case study is in the financial industry, and it's based on stock prices. You can use it for other things as well, commodities and perhaps Forex, but we're going to focus on stock prices today. And what we're going to do is use an analysis, a very common analysis called the relative strength index. The definition that you see here is from Investopedia. So you can go on, this is not something I fabricated. This is something that you can go look up on the web, and this is very common. Pretty much everybody involved in stock analysis knows what relative strength index, what it is and how you're supposed to use it. You might wonder, well, what does it mean? Well, the interpretation of RSI is fairly simple. If the value of RSI is greater than 70, that means that the stock is overbought or overvalued, and it's probably going to go down in price. Alternatively, if the relative strength is less than 30, then the stock is oversold, and it's likely to go up in price. So here's the process we're going to use. Oh, I should have changed this. When RSI is greater than 70, the stock's price is likely to decline. That's our first hypothesis. The second hypothesis is that when RSI is less than 30, the stock's price is likely to increase. So here's what we're going to do. We're going to use the Eumonics platform to test this hypothesis to see if they actually work. So here we go. Now we're live, and we're doing this without a net. So, well, almost without a net. So what we're going to do is come into this center. So if you're not familiar with Eumonics, we have a series of centers that deal with different domains, everything from stock analysis to election analysis, sentiment analysis, and so forth. But today we're going to focus on the financial signal center. So we're going to use this platform, this solution from Eumonics, to test our hypothesis. when you come in, again, if you're not familiar with Eumonics, each of these cards is an application. And as you can see, there's quite a few. The one we're going to focus on today is the Trend Explorer. So if you have a hypothesis, if you're trying to find causal knowledge or test causal knowledge, more than likely the first application you're going to want to use is the Trend Explorer. Now, as I mentioned, we're focusing on stocks. So we're going to, as our database, we're going to select S&P 500. And Apple has become a crowd favorite when we do these demonstrations. So I'll start with Apple. Now, the hypothesis is already defined for us on the left by default. So the hypothesis that we're looking for here is this objective function, monthly change. So what we're doing is we're looking for months where the stock price has increased. It's the change from one month to the next is greater than 0. And if you come up here, you'll see where the outcome function is shown in the screen. So we call this whole thing is a screen. So the Trend Explorer generates trend screens. And again, you can see what the outcome is for each monthly period. If it's red, that means the stock price went down. If it's green, it means the stock price went up over the course of the month. So again, our hypothesis is when the relative strength is greater than 70, the stock price is more than likely to go down. And when the relative strength is less than 30, the stock price is more than likely going to go up. Okay, so what do we do? How do we test this? So the first thing you're going to want to do is pick this thing called the closing price of Apple. And just so you know it's here, there's a lot of other variables that we can use: percentage change, volume, high, low, open. So, you can do variations on what I'm about to show you using different, target variables. But for now, we're just going to look at closing price. And what I'll do now is I'm going to add a feature function. A feature function creates, as you might imagine, a feature based on the input data. And what that means is a feature is just input data with added semantics, added knowledge. So in this case, the knowledge we're adding is the relative strength. So if I could type, I would find that we have over 100 feature functions in here predefined, and you can also define your own feature function. But in this case, we've already, the one I want is already here. So I'm just going to pick the relative strength index, and I'm going to add it to my trend screen. And now I can test my hypothesis. That's all I have to do. So specifically, I'm simply going to take this feature that we've added, and I'm going to add a filter by clicking on this filter icon. And the filter is going to say if the value is greater than 70, what happens? Well, it turns out 57% of the time, Apple's stock price goes up. Our hypothesis was that when the relative strength index was greater than 70, the stock price was more than likely to go down. But in fact, what we're seeing here is an indication that our hypothesis is wrong. When the relative strength is greater than 70, the stock price actually is more than likely to go up. So at least for our first test of the hypothesis, it turns out it was wrong. Well, let's check the other hypothesis. Let's see what happens when the relative strength is less than 30. And hopefully this one will be somewhat better. Now, our hypothesis here is that when the relative strength is less than 30, the stock price is more than likely to go up. And in fact, it didn't work. So when the relative strength is less than 30, the stock price is less likely to go up. Well, what does this mean? Well, first of all, it means our hypothesis is wrong, at least the way it was formulated. But there's some things we can do to vary uh, the specifics of our test. So if you recall back in the PowerPoint I was showing you, the testing methodology is to first start with your base hypothesis, see if it works. And very often, or maybe almost always, they won't. So the first time you come up with a hypothesis and test it, you're going to find it doesn't do what you expected intuitively. So what you have to do then is you have to modify, repeat till you find something that actually does. Now we have an automated learning process that will do this for you, but for now we're going to do all the steps manually, just so you have a sense of how this actually works. Okay, well, let's go back to our first hypothesis, and let's put it back at 70. Now, again, what we were expecting to see here is that when you see a relative strength higher than 70, the stock price was expected to go down. So now we have to understand, why didn't it? What went wrong? What's wrong with this hypothesis? Now, it might not be apparent, so I'll make it explicitly clear. All this data, all these periods that you see here to the right, this is your back test. So everything to the right is showing your historical observations. And I'll very quickly just run through what these mean. If you see a green circle that is empty, that's a false positive. So in this period, the stock price was expected to go up, and it didn't. The red circle is a false negative. In this instance, the stock price was expected to go down, but it didn't. The solid red means the stock price was expected to go down, and it did. And the solid green is when the stock price was expected to go up, and it did. So again, what this is telling us is that when the relative index is greater than 70, 57% of the time, the stock price goes up. And again, so now you can just scroll back through the back test, and you can see on each individual instance of our experiment, we can see what exactly happened. Okay, well, the first thing that may have gone wrong is the time period. So in this instance, we're looking at a time period of a monthly change. So let's change the time period, and let's make it 3 months instead of 1 month. Well, unfortunately, that didn't work. We want to see this number less than 50 to prove our hypothesis. And obviously, we're going in the wrong direction. So what this is telling me is that when the relative strength index is greater than 70, it's telling me that's actually a buy signal. It's actually a signal that the stock price will go up. It's exactly opposite of what Investopedia is using in their explanation. All right, well, that didn't work. Let's go back to monthly. There's another thing that might be wrong. Maybe 70 is too low. So let's make an adjustment here. Let's say, maybe it should be, let's say 80, just to see what happens. And again, it's going the wrong way. So we want to see this number going down. What this is telling me is that if the relative strength is greater than 80, that's an indicator that the stock price is going to go up. All right, maybe we didn't go far enough. What if we make this 90? All right, no, at least now it's going the right direction. But this is not consistent with our hypothesis. We don't seem to be making a lot of improvements we're not finding a better hypothesis. Well, there's another thing that could be happening. It could be that the behavior of Apple's stock price has changed over time. So maybe there's a period of time during which this theory does work. And it doesn't really do us much good if that period is between 1990 and 2000. So let's say, what if the period is between 2010 and today? Well, now this is a little more encouraging because at least the positivity has gone down a little, but even so, the theory just isn't working. The hypothesis that relative strength greater than 70 indicates it's overbought and is likely to go down, that's simply not working here. And again, we have there, obviously, we can layer in a mechanism here that will do this search for you automatically. You don't have to sit here changing numbers one at a time and flipping the signs around all manually. But what we're trying to do is get a better intuition, a better understanding of what's actually happening from a causal perspective. So when you do these kinds of manipulations directly, it helps you develop an intuition of what the analysis means, what the relationship might be. So let's play around with this a little bit. So simply saying that the relative strength greater than 70 isn't working, it's useful information because it tells you that when somebody is on TV, when they're saying that the relative strength is high, therefore you should get out of the stock because it's overbought, maybe you shouldn't believe them. But also maybe there's an opportunity for you to find something of significant value here. So maybe what we want to do is think of the prediction slightly differently. So specifically what we're saying here is that if the relative strength is less than 70, Apple stock price will go up in 68% of the following months. In contrast, when the relative strength is greater than 70, it's only 53% likely to go up. So what this is telling us is that the Investopedia information isn't necessarily wrong. It just needs a little more sophistication with respect to how you interpret it. So it isn't as simple as, hey, the relative strength is greater than 70, it's overbought, get rid of it. It's more relative to the gain you would expect when the relative strength is less than 70. The relative strength being greater than 70 is less attractive. Well, what does that mean? All right, let's take a look at that. We can quantify that. So here, the relative strength is greater than 70, and it's still kind of giving us a buy signal. But how strong is that buy signal? That buy signal has a magnitude. So let's take a look at this thing that says magnitude. And actually, we see something very interesting. I did not plan this. This is all serendipity. What our theory is that if the relative strength index is greater than 70, that means the stock price is going to go down. Well, now what I'm seeing is that there's actually various interpretations of that. So 53% of the time and 53% of the months, the stock price goes up, but the magnitude of change is a negative number. So even though the stock price is going up more often than not, on average, the stock price is going down. That's what this magnitude means. It means when this prediction is correct, the stock price on average is going to go down 47%. All right, well, let's flip this back around and let's change it to less than 70. Let's check that magnitude again. And now you'll notice the magnitude is green. So not only is the stock price more likely to go up, but the expected change is a positive number. So that this number here in the base value for Apple stock price change is $1. So on average, Apple stock goes up by $1.08 per month. And what we're seeing here with this magnitude measure is that the average price change when the relative strength index is less than 70, it's actually $1.63. So just to be clear about this, let me put this back again and just show this one more time. So when the relative strength index is greater than 70, the average price change in Apple stock is still positive. It's still 61 cents on average. However, it's significantly lower than the average over all periods. So again, I'll explain this one more time, and we'll probably have to do another demo to go into this in more detail. But on average, Apple stock price goes up by $1.08. When the relative strength is greater than 70, the increase is only an average of 61 cents. So it's not going down, which is kind of what our theory suggested, but it's not going up as fast as the average rate. So I want to be real careful in how I say this so as not to create too many problems. When the relative strength is greater than 70, the average price change is plus 61 cents. So the theory is wrong. The original hypothesis is absolutely wrong. And again, the original hypothesis was if the relative strength is greater than 70, the stock price should go down. And that simply is an incorrect hypothesis. However, you can change it. We can modify our hypothesis statement to be when the relative strength is greater than 70, the change in Apple stock price is on average less than the market average for Apple stock price. And the magnitude is negative 47 cents. All right, well, let's keep going with this. Let's do a few more experiments with this. So we've seen that the stock price, the predictive value of the relative strength index being less than 70 is pretty good. It's showing us 68% of the months we're going to see an increase in Apple stock price. Well, let's see if we can make that an even better predictor. What if its relative strength index is less than 65? Well, it went down. Well, what if it is greater? What if we're saying it's got to be less than 75? Well, I don't know. It seems like we kind of lucked into a sweet spot, because if we go above 70, the predictive value goes down. And if we go below 70, the predictive value goes down. Let's put it back at 70. And, let's just say this is the best we're going to do here. Let's flip the question around and let's look at the second hypothesis. So we're going to come back to this. So just remember 70. That should be easy to remember. It's in our hypothesis. So let's make this number 30. And you're going to see that it's actually a worse predictor. What if we flip this sign around? Well, now we're looking at something pretty interesting because, again, both hypotheses are absolutely wrong. Let's just check the magnitude on this to see what yeah. So both of the hypotheses that we started with are both wrong. So again, those hypotheses are if it's less than, the relative strength is less than 30, the stock price should go up. And what we're seeing here is that when the relative strength is greater than 30, you get a better result than if the relative strength is less than 30. Let's just check the magnitude on this, and it's a big negative number. All right, so our hypotheses are simply wrong. So what are we going to do with this knowledge? Well, how about if we do something like the following? Let's get rid of this. So now we got a clean slate. And now what we're going to do is we're going to create a new piece of knowledge. So we're doing this on the fly. This has not been practiced. I can tell you right now, I don't know what the outcome of what we're about to try. I don't know what's going to happen. All right. We are now going to create a composite filter. So we're going to combine these two things. So we're going to say, what if the relative strength is less than 70? So this is the number I told you to remember a couple seconds ago. And the relative strength is greater than 30. So what we're doing now is we started with the Investopedia explanation of relative strength, which, at least for Apple, is completely wrong. And we're now going to create a new piece of causal knowledge. And as soon as I hit return, oh, wait, it's already done it. So now we're up to 73%. And the magnitude is 0.96. So it's a much bigger magnitude, and it's far more accurate. So we're going to save this. We're going to call it our RSI test. Yeah, we'll just leave it at RSI. That's fine. So again, just to explain what's happened here, we'll do a real quick review. We started with these two hypotheses, and we found they're both wrong, at least for Apple. And then we went through a process where we modified the hypotheses, tested, modified, tested, till we came up with a new hypothesis. So our new hypothesis can be phrased as follows. If the relative strength is less than 70 but greater than 30, the price of Apple's stock is likely to go up almost double the market average. So again, I'll go back to the magnitude. It's a 96%. Well, it's an absolute 96 cents, and the it's we're going from $1.08 to 204, so it's almost double the monthly average increase of Apple stock. This is really good. This is very useful information because this happens 73% of the time. So this could we started with two incorrect hypotheses, and we've come up with something that you can actually trade on. Well, before you do, there's a third step you want to think about. We have to dramatically expand the data that we're using. Before you go out and actually spend money testing this hypothesis, we want to do the following. We want to take this thing, we're just calling it RSI for now, and we want to see how it behaves with a much bigger data set. So does this only work for Apple? In which case, maybe I've overconstrained it. Maybe this is just some serendipitous thing that as soon as you try it, you're going to lose all your money. You don't necessarily want to trade this. Let's see if we've actually created something useful. So what I'm going to do, we have this thing we call our screen generator. And I'm going to pick this thing that we just created. So this is a trend screen that we just created. I called it RSI. And we're going to apply it to a much bigger data set. Specifically, I'm going to apply it to every stock in the S&P 500. So I'm going to select every stock in the S&P 500, and off we go. So what this is going to do is take that that filter, or that screen, and it's going to apply it to. There's actually more than 500 stocks in the S&P 500. If you weren't aware of that, there's 500 and some. And we're going to see, does this, does this causal relationship hold only for Apple, or does it hold? Is this useful for all stocks in the S&P 500? What the screen generator does is it takes that screen and it applies it to every stock in the S&P 500, and it puts the outcome here in the screen library. So if I come in here, you'll see all the tickers that it's already applied it to. And RSI is the name that I gave the screen. So you'll see that RSI is appended to all these different tickers. And we're almost done with the entire S&P. Actually, I don't know how far along we are. Let's do a quick check. I'll do a search for RSI and just see how many of these we've generated. And we're up to 415. So we've almost completed the entire S&P 500. And then what I want to do is I'm going to do a search by score value. And I want to see greater than, let's say, 60. So if it's greater than 60, that's better. That's something that might be investable. And what you'll see here is that almost half, this screen works for almost half of the S&P 500. Well, what we can then do is we can say, let's create a trend map. You do that by, so what I want to do now is I want to analyze all these things together. I want to look at them in a composite form. So I'm just going to select all of these and create my trend map. And now I can get a sense of how good how useful a predictor this RSI screen is across many stocks. So I've now created a trend map where I'm applying the screen to in real time. This is giving me a real-time evaluation of all the stocks that you see here. And if you see a green here and this circle here is green, that's telling you that as of today, this screen is predicting that the associated stock is likely to go up in value. And if you see red, it's telling you that the screen is telling you that the stock is likely to go down in value. So now on your own time, what you can do is just start watching these. So what we've done is, for historical results, we've actually got a pretty good predictor. But now what we have to do is, from this point forward, we have to watch these things and see if they're actually useful for predicting future outcomes. And you don't actually have to do anything. You don't have to write anything down or remember anything. The Eumonics system will track it for you. But basically what it's doing is it's hiding the back test. So if I hit this button here, the back test is still here. It's just hidden. And what this gives me the ability to do is, from this point forward, I'll simply watch what's happening, and I'll be able to tell if these screens are actually predicting experimental outcome going forward in time. And within a fairly short period of time, I'll be able to determine if this screen we've created actually has causal, if it actually represents causal knowledge, if it's actually a good causal predictor of momentum, if it's using momentum appropriately to define when stock prices will go up and down, I'll be able to tell that going forward. So with that, I'm going to stop and thank you for your time, and please send us your questions, and we will be providing some additional demonstrations and analyses that will build on top of what we just covered today, that will allow us to go into a little more detail of how you can take this simple analysis and look for more complex causal relationships. So thank you for your time. Please send us your questions. Again, my name is Bob Whitehair, and feel free to direct any of your questions directly to me or anyone at Eumonics, and we'll do what we can to answer your questions. Thanks again. Have a great day.